In sport, every dynasty ends. The team that looks unbeatable, the one winning everything, the one everybody says will dominate forever. Eventually, they don't. And right now, millions of investors are betting that one particular dynasty never will end either. They've decided that going all in on America, the S&P 500, is the obvious, only sensible choice. Warren Buffett himself says most people should just buy it and never think about investing again. And for the last decade or so, he's looked completely right. But here in 2026, I want to make the case for the other option, the boring one, the global tracker. Because I think you'll see that you don't actually have to choose between America and the world at all. And that in a more uncertain world, taking the concentrated bet for a point or two of extra return might be the riskiest thing you can do. Quick reset on what we're comparing. The S&P 500 is the 500 largest companies listed in America. It's been around since 1957, it's weighted by size, and it covers about 80% of the entire US market. When people show you that chart of a few £100 a month turning into a fortune, this is usually the index they mean. A global tracker, something like a FTSE All-World fund, does the same job, but for the entire planet. Over 4,000 companies across developed markets like the UK, Europe and Japan, and emerging markets like China, India and Brazil, TSMC in Taiwan making the world's chips, Samsung in Korea, Toyota, Nestle, AstraZeneca right here in the UK. But here's the part almost nobody tells you, and it changes the whole debate. A global tracker is still right now about 2/3 America. Because it's weighted by size and America is the biggest market, buying the world doesn't mean turning your back on the US. You still own Nvidia, Apple, Microsoft, all of them at the top. You're just spreading the rest of your money across everyone else too. So this was never America versus the world. It's 100% America, or roughly 2/3 America plus everything else. Now, the case for going all in on America is simple. It's been winning and winning big. Go back to the early 2000s and the US and the rest of the world were basically level. Then America hit the gas. And this is where our brains betray us. It's called recency bias. We assume whatever just happened will keep happening. There's a study that found Eurovision acts performing last scored higher simply because people remembered them best. Same wiring. A decade of US dominance, and we all just assume decade 2 is a certainty. But zoom right out and you see something humbling. In the early 1900s, the UK was around 25% of the entire global stock market. Today, around 4%. The biggest market on Earth shrunk to a footnote. In the 1980s, Japan was so dominant that the land under the Imperial Palace in Tokyo was reportedly worth more than the whole state of California. That did not last either. Every great financial dynasty in history has eventually faded, and the people living inside it never believed it would. America is extraordinary. It spends 37% of the world's military budget. It dominates technology. But this time it's permanent is the one phrase that's been wrong every single time before. So why raise this now? Because the world in 2026 feels less certain than it has in a long time. We've already had a taste of how fast the mood can turn. Earlier, when America moved on trade and tariffs, we saw a sudden rush of money out of US stocks and into everywhere else, a sell America moment. The panic faded and US stocks recovered, but it was a reminder that the tide can go out fast when confidence cracks. And here's what a lot of people missed. Despite all that noise, a plain global tracker still had a strong 2025, comfortably past 20%, right alongside the S&P 500. Spreading your money across the whole world did not mean giving up returns. And then there's the big one, artificial intelligence. Right now, AI is the engine under American dominance. The handful of US giants building it are why the S&P 500 has pulled ahead. But think about what AI actually is. It's a great leveler. As it gets cheaper and spreads everywhere, the edge stops being exclusive. A company in India, or Germany, or Brazil can pick up the same tools and compete in ways they simply couldn't before. The very thing powering US outperformance could be the thing that closes the gap. I'm not telling you that will happen. Nobody knows, but that's the point. In a world where the moat might be shrinking, do you really want every egg in that one basket? And that basket is more concentrated than ever. In the S&P 500 today, the top 10 companies make up around a third of the entire index. Around a third in 10 names, mostly riding the same AI wave. In a global tracker, those same top 10 are closer to 15 or 20%. One of these is a concentrated bet on a handful of American tech giants. The other is genuinely spread. If the champion stumbles, you really feel it in one of these, and barely notice it in the other. Here's a risk that matters enormously to us in the UK and gets ignored completely, because most of the voices you hear are American. When you buy the S&P 500, you're not just betting on American companies, you're betting on the American dollar. Take last year. The S&P 500 did well in dollars, but the pound rose around 7% against the dollar over 2025. And because your account shows everything in pounds, a stronger pound quietly trims the value of those dollar gains on the way home. Same fund, same year. A UK investor and an American investor can walk away with noticeably different returns, purely because of the exchange rate. You can't escape this with the S&P 500. At some point, your pounds become dollars, and the exchange rate does what it wants. A global tracker doesn't remove currency risk, but it spreads it. Across the dollar, the euro, the yen, the pound and more, instead of pinning your entire future to one. In an uncertain world, that's not a small thing. Now let me be fair, because this isn't a hit piece on America. Two honest points cut the other way. First, on cost, the pure America approach actually wins. A simple S&P 500 tracker can charge around 0.07% a year. A global fund is often nearer 0.2%, a few times more, because tracking the whole world costs more in fees. Over decades, that difference is real money. It's small, but it's a genuine tick in the S&P's column. Second, and more importantly, nobody knows the future. The US market might just keep on winning. Yes, American valuations look stretched right now, sitting well above their long-term average, and history says expensive markets tend to deliver weaker returns from here. But expensive is a headwind, not a crash, and markets can stay expensive for years. If you'd bet against America any time in the last 15 years, you'd have been wrong. So anyone telling you global is guaranteed to win is selling you something. It isn't guaranteed. It's just, in my view, the more sensible bet when you can't see the future. So let's bring it home. Going all in on America might earn you a point or two a year more than a global tracker, but only if the last decade repeats, and you only ever know that in hindsight. Against that, you're taking on more concentration, more currency risk, and a bigger bet that one dynasty defies history. That's a lot of risk to carry for a couple of percentage points that may not even show up. And remember, you're not giving America up. Buy the world and you still own roughly 2/3 America anyway. You capture the champion either way. You just stop betting your entire future on them never losing form. It's like picking your team for the whole season, based only on who won the league last year. Sometimes the champion repeats, often they don't. Owning the whole division is how you stop caring who's on top this year. One last thing, and honestly, it might be the most important. If you've got less than £100,000 invested, this whole debate barely moves the needle. An extra 1% a year on a modest pot is pocket change next to the difference your contributions make. The thing that actually changes your life at this stage isn't S&P versus global, it's how much you put in every month. That's the bit you truly control. So pick the one that lets you sleep at night, set it up, and then pour your energy into your income and your contributions, not into second-guessing this choice every week. If this helped you think about it more clearly, send it to one person who's stuck on the exact same question. And happy investing.